Welcome back. You're watching HFO-TV.
All right, welcome back to HFO-TV. I'm Greg Frick, partner here at HFO Investment Real Estate, and today we're lucky to have Toija Beutler of Beutler Exchange Company. She's the owner and founder of the company that does 1031 exchanges.
That's all we do.
We worked a lot together over the years. I thought it'd be great to bring you in and kind of talk a little bit about some of the new tax code changes and how they have affected exchanges, and then we'll kind of go into some other details. So maybe, again, thank you for coming. What's kind of changed since 2017, the new tax code and the effect of exchanges would be great to know.
Right, most significantly out of that tax code change, the fact that we can no longer do exchanges of personal property.
Okay.
Well, for us that was typically equipment, trucks, cows, but when cows literally, but
so I don't know if people realize you could do exchanges of our cows, cars.
We used to be able, exactly that. We used to be able to. Where it impacts our transactions these days are in the sale of a large apartment complex that has contents, appliances. When we sell an apartment, buy an apartment, of course you're selling with contents, and you would buy with contents, and it was like kind of real estate and the contents.
And the personal property, so we'd put a personal property list together, washer, dryers, things like that, and assuming on the building, if we're gonna buy an apartment, we're buying another apartment, and there's some personal property, and it kind of wash out.
Right. So nowadays, where we can only do the exchange of the real estate, our client is going to be taxable on the sale of the contents in the one property, a recapture of depreciation there. But on the other hand, when they go to buy the new property, under the current changes, they can do 100% expensing of the personal property purchased in that new location. So it's not a bad situation at this point in time for our client, but it was certainly a change in the landscape.
And then that's a good question. And so in some of these transactions, when you've got a personal property, now that there's a value signed to it,
right.
Do you ever have where the buyer and seller don't necessarily agree on the value of the personal property, and what's your recommendation on that? Right,
so absolutely, they won't necessarily agree. Naturally, as the exchange folks, we're going to send them to their accountant, their attorney. I mean, ideally, they're going to come to an agreement before they complete the, exactly. But if there's no agreement, and typically we won't see any valuation of contents, the personal property in the contracts.
Right, it's usually just a list. The personal property is included, and the list will be included, part of the due diligence.
But we know that by the time they get around to completing their tax return, there will have to be some value assigned, and the buyer and the seller have to have come to the same number. But we're really putting them back to their attorney, their accountant, to wrestle that out.
To deal with that, okay. So at the end of the day, it may not. It's a change in terms of how things are allocated, but with the the increased depreciation where you're able to expense everything, it may be
pretty good deal still for our client.
Okay.
Yeah.
Another question that comes up is what's the most confusing thing people have about 1031s or?
There's a couple of things that they don't seem clear on. The first being replacement debt.
Right.
A lot of our folks perhaps they're selling a property for, let's say, $2 million, and they've whittled that mortgage down to $500,000.
Okay.
And they would like to take the equity of $1.5 million and just go out and buy replacement property free and clear for $1.5 million.
Right.
Right.
Changes life circumstances. They don't want to take another loan.
That's right. And often our clients are really in their 70s and 80s.
Right.
And they're debt averse at that point in time.
Right.
So they want to go out and buy free and clear for $1.5 million. Ooh. They can't do that.
Right.
Yeah, they're going to get taxed on the debt relief. They're going to get taxed on debt relief.
On the debt relief if they don't match it. Got it.
That's right. And they'll be very shocked by that answer from us. And we're the first messenger on it. We're used to them yelling just a little bit and sputtering, how can that be? How can that be? That's not right. That wasn't my money. That was the bank's money. But that is really what 1031 is all about, is an incentive program. For folks that have $2 million in the American economy, as they're selling that asset, they got to pay tax, don't want to pay tax, why then they have to go back into the economy, $2 million. That's right. And I will be in DC in October on the Hill explaining that 1031 is good for America and as an incentive program to keep those dollars at work in the American real estate economy. And so we really can explain it to folks who think they can just go back in at $1.5 million. No, it's $2 million if they want the reward of 1031.
So that kind of brings something. I know there's been talk, through the years. We've talked various times. Whereas 1031s federally have been on, I don't want to say the chopping block, but there's been thoughts of, what happened this last tax code looks like they just kind of pared down what qualifies for 1031. Right. In your industry, is there still a concern that this is going to be looked at as, we need to eliminate the 1031 process?
So in the last tax code change, we managed to preserve 1031 for real estate, but did lose it as to personal property.
Right.
Yes, we're watching all the while because 1031 with the last tax code changes got itself on a list for a pay for, meaning how are we going to take care of this deficit? Well, why aren't those people with the investment properties paying their taxes?
Paying their fair share.
If they paid their tax, we could take care of the deficit. So we got ourselves on what is called a pay for list. And once you get on that list, you're never getting off. So we become...
so this is a federal list for different tax things. Once you get on it,
there you are.
Got it.
And 1031 has been in the tax code, mind you, 98 years. We're coming up on a centennial. But we got ourselves on that list, so it continues to be a subject of discussion, which is why our industry, we're back there lobbying twice a year. Right. Our concern with this next go-around is, and we do talk about this, I was in a meeting in New Orleans this last week and we talked about the concern. And what if the House, the Senate, and the President were all to go Democrat? We're going to be very nervous then about preserving 1031. So it's on the list and we just have to continue to
Now, this is something, I mean, again, in our world, we're on the investment side of multifamily, but I do know in talking, that the National Association of Realtors are adamant for keeping this in place as well. So it's not just the investment side, it's also the single family, kind of lobbying groups, which may help in preserving and I guess you'd say moving forward, I would hope.
Right. In our office, of course, we're heavy on apartment type properties, multifamily, but our work is across the board and we do, probably half of our work is just single family rentals, folks that have picked up rentals over the, a span of time, but office properties in all types. And so NAR is definitely concerned about it, again, as an incentive program to keep those dollars in the real estate segment of the economy.
Right, as opposed to, yes. Well, hopefully it's, like I said, I've felt the last 5 years there's been more, I would say, angst on, the industry about.
There has been.
The spotlight's now on it, and once your spotlight's on it federally, and then is there talk statewide where states could try to exempt themselves from that? Or
so at this point, all states follow federal on 1031 except Pennsylvania.
Okay.
So otherwise, no, the states are pretty well situated. They'll just adopt whatever the feds are doing. California's taken a little different perspective on some aspects of 1031, but not significant. So really the states follow federal.
And in terms of that, so we've got a lot of owners in Oregon and Washington. The question that comes up with a lot of us, or a lot of clients is, I own in Oregon, I live in Washington, I want to trade out of Oregon, and I trade to another state. Is my 1031 allowing me to do all of that, or am I paying the state portion of the gain? What's your...
So the good news is they absolutely can trade out of state.
Okay.
But Oregon, California, and Montana do have a provision that you don't pay as you exit the state. But if at some point in time, say they sell in Oregon, buy in Washington, at some point in time, if they decide to sell the Washington asset without doing another exchange, then they're going to trigger federal taxes, and at the point they trigger federal, because they're not doing an exchange,
they're going to have to pay the back state
They've got to come back to Oregon and pay Oregon. And California and now Oregon are requiring informational returns every year from the taxpayer, reporting that they still own the asset in Washington, I still own the asset in Washington, and at the point they answer, check the no box, they no longer owe.
So even though they're not filing a return in Oregon because they don't live in Oregon, but because they were at one point, there's an informational tax return needs
every year has to be filed. California's attitude is that if you don't file in that particular year, you're triggering the tax on your gains you preserved earlier. So we do have a clawback provision in Oregon.
Oh, interesting.
So they're not escaping Oregon even by going out of state. But they totally may
They can
leave
defer
the
though. You're able to defer. Okay, gotcha.
Yeah.
So another thing is, maybe you can explain a little bit about, I think a lot of, our audience are familiar with what we call a typical exchange. You have an asset, you sell it, and you go buy your replacement asset. Maybe explain a little bit about a reverse exchange.
Oh my, the topic of the morning. I've had nothing but phone calls today on reverse. So reverse exchange is where our client has found the replacement property and is needing to close on it before their sale has closed. And the IRS allows them to buy first, sell later, but what they won't let the taxpayer, that's the IRS word, not mine, what they won't let the taxpayer do is be the owner of both properties at the same time.
Got it.
So what happens is exchange companies such as ourselves has to go in there, and we're going to be the temporary owner, usually of the new property, but it's possible to park, as we call it, park the old property. But generally what happens is we go to close on the new property, the seller deeds it to our company, not to our client. We do lease it back to the client, so while we own it, they have full control.
It's almost like a
Economics,
lease back. Right.
it's exactly what it is. Now, so the first trick is we have to be the technical owner. Secondly, only 180 days.
So you got 180 days to, so that time frame's the same.
Totally.
So what's your experience with lenders in terms of that, where they're doing a reverse and you're the owner, but the borrowers or the taxpayer owner, what are they doing on that?
So the good news is on our commercial type properties, multifamily, the lenders are cool with it.
Right, they understand.
Yeah.
Okay.
We just have to explain it to them. We need 2 sentences included in the loan documents, but they're fine with it. And we will have our client be the manager of our LLC, and so
and again, it's only a
fine.
6 month.
It's only for 6 months.
Gotcha.
Yeah.
And then, so then there's that exchange, which again, we see it a little bit on the reverse exchange. Typically, it's, do you have the equity in your property you're relinquishing somewhere that allows you to buy that other property?
Right.
That's usually the big driver, which keeps it from doing that. Then there's the improvement exchange we get asked about a lot.
Well, that was a third of my calls this morning.
Yes.
So our client, for instance, our client is selling a property for $5.5 million. What they want to do is buy land and build another apartment project. And well, they can. And the word I use is theoretically. They can theoretically undertake an improvement exchange. Well, why do I use the word theoretically? 2 reasons. First of all, may sound familiar, our client cannot be the owner of the dirt while the construction is taking place.
Okay.
Not that initial phase. So we end up being the technical owner of the property temporarily. Secondly, and this is the big one, only 180 days. And
so your improvement value, the improvements, it's not the dirt, it's the improvements, have to be equate to satisfy the exchange, and you have 180 days.
That's right. The one this morning, their project is going to be $16 million all in.
Okay.
The dirt is $1.5 million. Well, again, remember, we sold for, let's say, 5.5.
Right.
We're buying dirt for 1.5. So we just need to put we only need to put $4 million in 180.
Side.
Yeah. We don't need it to finish at 16 million. We just need it to 5.5.
So you can identify different percentage of completion.
Right. So partial completion is fine. I'm being told on this one this morning, well, they think they can do the excavation in the 180 days, but they're not. They're going to be stretched to get another $4 million in there in just 180. So that's the reason I use theoretical. I'm happy to do it. They'd like to do it, but we really don't get much time.
And will the IRS put a value on, permits and, that, hey, I bought land for $1.5 million, but it's, unpermitted, now it's permitted and it's worth this? Is that in?
We do, and that was part of the discussion this morning, is soft costs.
Right.
So there's no definitive answer from the IRS about including soft costs, but as an industry, the top, companies in my field
are doing it.
We draw it in. When we need that value in there, we draw it in. There's ways to bring it in. And it's not been challenged. So we bring in the soft costs that they've already incurred, and then any hard costs that come in future.
And then what about if they have a property, they own the land, can they exchange into just the improvements?
Guess what? I had that call this morning too. It was a busy day.
I'm telling you, wow. We just have the same people calling around. Yeah,
well,
we did give your name out to quite a few today.
Well, thank you very much, actually. So they cannot build on a property they already own.
Gotcha, okay.
They can, I'll just throw this in to complicate life a little bit, they can build on a property owned by a related party.
They can. Related party, yes.
Related. But it has to be organically when they first come to us. It's already, mom and dad own the property, son wants to build a Taco Bell on there or something. They can't build on property they already own. Right. They can build on property owned by related, and then we can do the improvement exchange.
But there are restrictions on related property on a standard exchange.
Oh my goodness, yes. A lot of rules around related party.
But the related party, we can do a related party on the
Yeah, the basic is we can't buy from a related party. Oh my gosh, no. Oh, but we can build on a related party property.
Gotcha.
So,
okay.
And I will say this, in discussions, meetings we've had, the IRS has told us they're going after related party.
They are.
Yeah, they totally are. They go after related party, they go after boot, meaning cash or debt relief, right? And they're going after compliance with a 45-day deadline. And really, we see the states going after compliance with a 45-day deadline because they found, years ago, people were a little loose about that, but not.
Right, and the 180 is pretty easy to follow, but the 45 was
miserable.
Right,
too short.
Right.
The list is too short,
right.
And they have to buy from the list. So.
And are you seeing in your world? Are you seeing municipalities going after looking at the validity of these exchanges more often? More so than they did 5-10 years ago?
Well, to be honest, we still see only 2 to 4 a year that get audited. We're running right now over 100 exchanges a month, 2 to 4 a year.
Okay.
And it'll be almost exclusively around the 45-day deadline.
Well, that's the big.
That's the big one.
Okay.
Whether it's the feds, the state of Oregon, the state of California, it's around compliance with the 45.
Making sure that the 45 has been identified within the time frame. They identified either 3 properties with the 200 rule, 200% rule.
Yeah. May I bring up another
Yes.
point that's really causing us? I'll take the floor here. Partnerships. And that is the most challenging topic of discussion in the office. When folks are in a partnership on a property being sold and they don't want to stay together.
Right.
And somebody calls me with that question, I have got about 9 different ideas in my head. None of them really good. And we're finding California's going after these partnerships. The drop and swap will drop people out and then do your own thing. I think there's a safe way to get people out, but it takes a great deal of advanced planning and seasoning.
It's not something you can do, oh, by the way,
At
we don't want to
closing.
do an exchange together, let's drop and swap.
No. And we heard from the state of California last week in New Orleans, and they said, oh, they're disallowing. If they're dropping right at the closing table, that's not going to fly. If California looks at it, the feds are not really looking at it right now, but I expect they would follow the state of California, frankly.
So are you still doing the same recommendation if you're in a partnership, you foresee that you're going to want to go separate ways, do a drop and swap, drop one tax year and maybe sell the next tax year?
Yeah, exactly. Okay. So we want them to drop out the year before sale, so that goes on that year's tax return, exchange sale on a different year, and then for your purposes, the listing agreement would be by the tenant in common owners, not the partnership, and the PSA would be tenant in common. And frankly, when they first dropped out the year before, they got to go back to the bank and deal with that loan that was originally made to the partnership. So it's a real tough situation to be in. Theoretically, we're able to get them out, but it's a lot of work and advanced planning.
And California is now saying they're looking at that.
They're absolutely getting cases out now. They're disallowing a drop. Certainly what they're looking at are drops right at the closing table. That's not going to fly anymore. It's the way we used to always do it, of course, but no longer.
Yeah, interesting. Okay, well, that's good to know.
Yeah, I'm telling you.
So basically,
right on the
for our
front
audience, if this is something like in a partnership and that's a plan, this is something you need to do in advance of saying, hey, look, by the way, we're going to sell. If there's a thing we want to do an exchange and go separate ways, this may anticipate you're going to take a year to plan this ahead of time.
A worst case scenario, what we get is they're going to drop right here in September of 2019, and then the listing can be entered into in October, and you get a buyer in November, and the sale closes January 2nd. So there's not a year of seasoning.
Right,
I would
but there
prefer.
is some pre-planning in there that needs to get done.
That's right, and at least the drop was one tax return and the exchange on a different.
Got it. And it okay.
It's the best we can do.
Gotcha. Okay. Well, great. Well, thank you for the update. It's very, very helpful. I'm sure we'll have more updates coming.
Oh, I always have news for you.
I know. And we'll see you next time on HFO-TV. Thank you. No, it's great. Thank you.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.